Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Sales International Limited. And here is your weekly technical analysis of LME 3-month nickel, zinc and tin. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of these patterns, levels, analysis or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
LME 3-month nickel. The break higher during Christmas week up over the gold long moving average, currently at 15,660, as well as over the key levels at 15,665 and 15,840, saw a significant release of bullish energy that had been pent up for about 2 years. So what has this move up left us with? Well, as I said 4 weeks ago, and it's a long piece I'm afraid, and I quote, we have four features to watch out for. The first was a possible double top, that now might be possible triple top formed over January. This pattern depends on one key factor, whether or not prices can drop down to the low zone of 16,835, seen 3, which is now 7, seen 3 weeks ago, and then after that, whether the market can press even lower or not. At the moment, this seems unlikely, but it's still one to watch. The second is to consider if prices try to get down to that 16,835 zone and fail. We might then have to regard the whole December 25 to date action, or any part therein, as a possible bullish halfway hesitation. This is another thing to watch. Thirdly, we have a crossover seen 3 weeks ago, so once again that was 7 weeks ago, of the rising green short medium moving average, the mauve medium moving average and the gold long moving average. This is a bow tie formation, and the moving averages have gone in and exited in the right order with a bullish tinge about them. Consequently, we need to look to the future, and that means that between 15 to 20 sessions after crossover we can look to see one or more of the following: a change in trend, a reinforcement of an existing trend, volatility. Thus, please pay special attention to this market between the 29th of January and the 5th of February, as that is the window. The final feature is whether to regard the whole January action as a possible ascending wedge pattern. I cannot give an idea of direction or targets either above or below, but I can give an idea of the potentials involved. Thus, for a confirmed break higher, we would have a primary potential of plus $1230 from the break, and the secondary hard to reach potential of plus $1950. For a confirmed break low, we'd have a primary potential of minus $625 from the break, and a secondary hard to reach potential of minus $1950. Please be wary of any breaks higher or lower, and it may first be a false break before a true break occurs. End of quote. Well, as you can see, the market chose the ascending wedge pattern idea for a break lower late 4 weeks ago. This gave a primary target in the 17,400 zone, which was reached the same day, but a harder to reach secondary target X1 still down in the 16,075 zone. I also added on this point the following 2 weeks ago, and I quote, "Now, this secondary target may be unobtainable for this pattern, as the action of the last 2 weeks can be one of two ways. It could be a possible horn bottom, in which case we'd be looking higher, though as yet the market has not triggered the appropriate level up at 17,680, or it could be a possible bearish halfway hesitation, for considerable distance on the downside. But again, the market has not triggered this level, down at the 50% Fibonacci line of the 2025 to 2026 move at 16,515. What is interesting is that perhaps, just perhaps, the market is not that interested in doing either right now. Watch, wait and see." End of quote. Well, things are a little clearer, as the idea of a horn bottom can best be described as a fully constructed horn bottom that failed, for pipe top following 2 weeks ago. This leaves us with the idea of the bearish halfway hesitation. But here, well, we haven't failed, not yet, but we haven't triggered the pattern either, as we have stayed above the 50% Fibonacci line at 16,515. Additionally, we may be running out of time to hit the trigger as well, as we have the green short medium moving average currently at 16,930, moving up swiftly to meet the market. That is why today's action, sharp action higher, looking like a bullish opening long white Mariposa that has punched back up over the combination of the October 2019 high and the 50% Fibonacci line of the April 24 to May 25 move, both at the same level. Why that action looks so interesting. If this action is sustained, then the late January today action might just be a double bottom. However, any retracement will put the pattern in danger of becoming a bearish cat's ears pattern. So the next few days will be very, very crucial. LME 3-month zinc. There had been here and still are a number of patterns affecting the market in recent times, all happening all at the same time. The first has been, and I suppose still is, the dark blue mid-July to early October 2025 bull channel, currently 31.63 to 33.76, though we now seem to be exiting out of this pattern right now today on the upside. However, this bull channel has been breached a number of times in the past, though the market will still not let it go. The second pattern is the bright red May 23 to April 25 bullish Andrews pitchfork, especially the middle time, which is currently at 33.59. This is the core bullish pattern here, as it halted the rise 6 weeks ago, along with the dark blue upper bull channel line. This breach higher was also capped, well, sort of, by the 250% Fibonacci lines of the March 20 to March 22 move at 33.29 and the 50% Fibonacci line of the April 22 to May 23 move at 33.77, which are today below the market. Indeed, you could say these two helped erode the bullish incentive enough to try to form another possible pattern, which I'll detail shortly. Meanwhile, a third pattern emerged to become evident 4 weeks ago, and that is the bright green mid-December last year to date, imperfect but seemingly valid, bright green steeper bull channel, currently 33.05 to 35.12, which still seems to be trying to take over the higher running of this market. As I said last week, I'll watch this part very carefully now. Okay, I also spoke about another newer pattern, and that was to regard the whole late January to mid-February action, as I said last week, as a possible very, very lopsided double top pattern. It's a bit of a squinty eye thing, but you could see it as such. If this is the case, and I'm at this moment far from convinced, then I could just about indicate some potentials on the downside for such a pattern. End of quote. Well, doing that ended up being a waste of time, as we have now today a third spike higher, and the idea of a double top, well, that can be discarded. LME 3-month TIM. We had a gapping higher move in mid-January that started a whole huge move higher seen later in January. The rise was fairly swift until the market breached the previous all-time high seen back in 2022 at 51,000. The day after this happened, the market started to fade. However, prices turned back higher just after mid-January, and we rose up to reach the one big old pattern, still even now dominating this market, and that's the bright red upper time, currently at 58,265 of the big old 2020 to 2022 bullish shift pitchfork. This was tested twice, but held as a resistance 4 weeks ago, which is very telling for such a pattern that is between 4 to 6 years old. Now, 5 weeks ago I said about the future movements here, and it's a long quote, I'm afraid, and I quote, I think there are two courses for this market to go. The first is to try and replicate what we have seen in other metals, move up and try and form a possible double top. In this regard, I think this market is a little late when compared to other metals, and I think even possibly too late for such a pattern. But we shall see. Second is to fall back and fill in the gap left in early January below, between 45,780 to 46,255, and then decide what to do. End of quote. Now, I also added 4 weeks ago, and it's another long quote, I'm afraid, there is a third way, and the market has seemingly chosen to strike for that. and that's to look at the whole mid-January today action, indeed the whole late December last year today action, as a possible very large bullish halfway hesitation. And indeed 4 weeks ago that looked like the way it might go. But I added last week, and again I quote, however, since then yet another pattern, a fourth pattern has emerged, and this one seems to be the key dominant short-term pattern here, if perhaps a little unorthodox. It's a possible January to February based head and shoulders top, a quite large one, and one that has possibly two right shoulders labelled S and S2. This pattern depends on one factor, and that is the dark blue neckline for this pattern, which is currently at 43,140. This needs to be broken on the downside to become a head and shoulders top, or it needs to be rejected to form a rarer head and shoulders continuation pattern. End of quote. We were close to breaking lower below the dark blue neckline this time last week, but the market had one obstacle to overcome, which it seemingly failed to do, even though we had closes below it. It is the green short medium moving average, currently at 46,615. I said so, if in a sort of a roundabout way, last week when I said, and I quote, we were close to doing so 2 weeks ago, so that's now 3 weeks ago. Close to doing so 2 weeks ago, but we still haven't managed it, though the latest market moves yesterday have seen prices close below the green rising short medium moving average. And today, so that is last week now, and today we are once again below this moving average. I suggest only a move up over the 2022 high at 51,005 would negate the pattern idea, but as we have broken the dark blue neckline as we haven't broken the dark blue neckline as yet, I can't give targets, and I'm loath to give potentials below, as I would like to see the action around that dark blue neckline first. End of quote. Since that time we have seen prices rise significantly higher, maybe not as high as 51,005, not yet at least, but a gapping move higher today that has covered a lot of the ground up to that level. In the process of the latest move higher, we may have set up the conditions for a possible February-based double bottom. It is still early yet on this idea, but the 51,005 level would act as a nice trigger line for such a pattern.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.